Now let's discuss what happens in the liquidation of a partnership. When a partnership is liquidated, the legal and economic life of the entity ends. In order to liquidate, a partnership needs to sell all of its non-cash assets and recognize the gain or loss from the sale of those. Then allocate that gain or loss to each of the partners based on their income allocation ratios. Once all the cash is accumulated, then all liabilities are paid off, and any remaining cash available is distributed to the partners on the basis of their capital balances. Let's assume that this company is liquidated, and this is what shows in the general ledger at the time of liquidation. The assets the partnership owns, as well as the liabilities owed, and the owner's capital balances. We're going to assume that there is no capital deficiency at the end, and the partners of ACE agree to liquidate the partnership on the following terms. The partnership will sell all of its non-cash assets to another company, Jackson Enterprises, for $75,000 in cash, and the partnership will pay its partnership liabilities. The income ratios of the partners are 3 to 2 to 1 respectively. ACE sells its asset all of its assets for $75,000. So they are going to debit cash for $75,000, and they are going to show all of these assets being sold, crediting all of the asset accounts along with the equipment's accumulated depreciation. The difference between the cash received and the book value of all these assets, if we were to add these up, it's $60,000, which is the accounts receivable plus the inventory plus the equipment minus the equipment accumulated depreciation. The assets are all worth $60,000. They were sold for $75,000. There was a gain on the sale of the assets. It's called a realization because we actually sold the assets. That gain is then allocated to the partners based on their income ratios, which is 3, 2, and 1. Thus, the gain is now debited to decrease that account. Of that gain, 3/6 goes to our net, 15,000 times 3/6, or 7,500. 2/6 goes to carry, or 5,000. And 1/6 goes to Eaton, or 2,500. Now that all of the cash is accumulated, all of the liabilities of the partnership are paid off. The two creditors are notes payable and accounts payable, debiting those accounts as they are paid off, crediting cash for the cash used to pay off the partnership liabilities. After those liabilities are paid, the balance in the cash is now $49,000, which was the beginning balance in cash, plus the cash received when the assets were sold, less the cash used to pay off the debt, ending balance of $49,000. The ending balance's cash is allocated to the partners based on the value of their capital accounts. Of the total $49,000 in cash, $22,500 will go to our net, $22,800 to carry, and $3,700 to Eaton, essentially cashing out their capital accounts. Here we're seeing a total summary of all of those cash payments, showing that by the end of the accounting period, the final balances in the partnership general ledger are all zero. There are times when a capital deficiency exists at the end after the company's assets are sold and debts are paid. For example, assuming the same scenario for ACE company, if we have a capital deficiency, any losses that are suffered from the realization are distributed amongst the partners, and because of company net losses or excessive drawings, there may be a negative capital. So assume that ACE is on the brink of bankruptcy and the partners decide just to liquidate, sell everything off, sell everything at a discount, just get rid of everything and walk away from the partnership. If ACE receives cash from the sales and collections of customers of $42,000, they'll end up with a loss in the liquidation because they will be selling off their equipment, their accounts receivable, their inventory, and their equipment, leaving them with cash received of $42,000 for assets that are worth $62,000. They will end up with a loss on the realization of $18,000. That loss needs to be allocated out to the partners. So we will credit the loss and divvy it up amongst the partners based on their income ratios. 3/6 to Arnett, 2/6 to Carrie, and 1/6 to Eaton. Notice that these debits are decreasing the partners' capital accounts. The next step would be to pay off the debt of the partnership, debiting notes payable, crediting accounts payable, just as we did before. What we end up with is a deficiency. Notice that when we get to the end of the period after the allocation of the loss, Eaton ends up with a deficiency of $1,800, a debit balance in the capital account. We can request that the owner with the deficient capital balance essentially pay it back to the partnership. So Eaton contributes cash to make up the deficiency in the account. The partnership debits cash and credits Eaton's capital account to clear out that deficiency. Finally, in the end, the remaining cash of $17,800 will be distributed to the owners based on their capital balances. Eaton will have a zero balance in the account, leaving all of the remaining cash going to the other two owners, Arnett and Carrie, in the amount of $6,011.08. It is possible that the deficiency is not paid. So that deficiency would just be written off. In other words, the partner with the deficiency refuses to pay it off. So that ends up going into the other owner's capital accounts, and they would just have to split it up. So here the deficiency is split up 3/5 to Arnett and 2/5 to Carrie, decreasing their capital accounts by the amount of the deficiency, resulting in less cash to be distributed at the end. The cash that would be distributed would only be $16,000, decreasing the partnership's cash and cleaning out the owner's capital accounts.